Hi, and welcome to Inside Trading, the show that's all about trading. Now, every week we discuss what trading is all about and what are the required habits that are necessary to be a successful trader. We also share trading ideas and themes of and all this is geared to helping you make money. As always, we have with me my co-host Panvilung. He's the founder and CIO of Track Record Trading Academy. V, welcome to the show.
Hey, it's good to be here, Brian. Let's talk about trading.
Absolutely. Now, as always, we start with a quote, and today's quote is from Warren Buffett.
So he says uncertainty is the friend of the buyer of long-term values. So that means that it's when markets are uncertain, as it is now, we have war in Ukraine, war in the Middle East, we have political worries, political uncertainty in the US as well with the looming presidential elections next year. We have the Fed closing in on the end of the hiking cycle, or maybe not. Inflation heading lower, but is it going to research higher? We have all this uncertainty in the pipeline, but it is a great market, great conditions for someone who is looking for long-term value because given market uncertainty, good prices, good values, good assets tend to be undervalued because of the overall market environment as well. So it's a good time to look for long-term assets that we want to own.
Okay, on that note, then let's take a step back and look at the situation, starting with what the Fed's doing and how you think the Fed is going to moving forward.
That's great. Because last week we had the Fed's November policy meeting. So what they did was they paused and they said that they paused as expected. They kept interest rates at a high level of 5.5%. They also said that the projections of one more interest rate hike before the end of the year may not be fulfilled. What the Fed Chair Powell said was that they did publish a projection, the dot plots, known as the dot plots in the September policy meeting. On a quarterly basis, they will publish each member's projections of where interest rates will go for the rest of the 2 years going forward. And most of the majority of the members projected one more rate hike before the end of this year. But he did say that as time has passed, the accuracy of the projections tend to be decaying because we are now closing in on the next projections as well. And a lot of data has come out since then, and their views could be changing. And indeed, I believe their views have changed. And the Fed chair also did say that we are close to the end of the hiking cycle. And I think this is also reinforced by the data, the job markets data from the US on Friday, when we saw unemployment rate rising unexpectedly to 3.9%. Expectations was for it to remain at 3.8%, and the number of jobs added was also less than expected. And this is the highest unemployment rate since January 2022. So as you can see, the Fed is getting what it's been wishing for since it started its aggressive rate hike cycle. They've been saying that for inflation to come lower, they do need to see moderation in the jobs market, and we are starting to see that. And that is giving them more confidence that they can remain patient with more interest rate hikes going forward as well. Of course, they have a dual mandate. The other thing that they look at is also inflation. And as measured by the consumer price index, inflation is at 3.7%. That's come off the lows of 3% that we saw a few months ago, but it is still lower than what it was in April 2021. It's way off the highs of 9.1%. It's headed towards a 2% target. And recently, the last few data points we've seen is that the actual observations of inflation has come out slightly lower than expected, which is good, right? Which means that it's slowing down faster than projected by most economists and statisticians, and also possibly the Fed as well. And that should give them confidence again that there is no need to hike further, because as inflation comes off, real interest rates, which is nominal interest rates, which is the interest rates that we see but when it's subtracted from consumer price index from the inflation, that's the real interest rates, the interest rates that is exerting the slowing force on the economy is getting higher as well, because as inflation goes lower, nominal interest rates remain the same, real interest rate goes higher. So we are seeing that also having an impact on the economy.
And also one of the key things is, and we cannot discount this. This is all playing to the fact that the Fed can now take a more cautionary approach, because in the past there have been instances where the Fed has probably been overly aggressive and pushed the economy into a recession quicker. So this leads credence to the optimism around the fact that the Fed can engineer a soft landing.
Yes, of course. As if you as you mentioned, if inflation comes off aggressively, comes off towards the target without more action from the Fed, that would be good, right? That will be increasing the chance of a soft landing. A soft landing, for those who are curious, not so well versed in the financial terms, soft landing is when there's a slowing down in the economy, but yet not too slow, but not too hot, right? Not hot enough for the economy is not too strong enough to generate inflation, but not so slow enough, not so slow that it sinks into recession and cause the Fed to start to worry about having to boost the economy as well. So as you said, the chances of soft landing is starting to rise because we are seeing moderation in the jobs market, we are seeing moderation in inflation as well. So what is next? I think the question is, what is next? The Fed now has to see with the inflation and labor market softening, the Fed, of course, as you mentioned, will start to think that there are chances for a soft landing, is getting to be more optimistic. So they don't need to be aggressive. They don't want to be aggressive because if as many people also know, and as we have mentioned several times on our program before, that the rate hikes take time to impact the economy. So there's still a lot of lagged impacts that has yet to be felt by the economy because the Fed raised interest rates very aggressively in the past 1 year, right? It took from zero interest rates to essentially 5.5%, and that's very aggressive over the course of slightly more than a year. And they can hold back now on being too aggressive, and they have acknowledged as such as well. And therefore, the likelihood is the rate hikes are no longer the base case. And as we go into next year, if the economy continues to slow and inflation continues to come off, rate hikes may start to come into play as well. And we'll start to hear about more of this in the financial press as we head into next year. So what else does it mean? What does it mean for risk assets? I guess this is what we are most concerned about. How do we make money from this? Is that the tough period for risk assets, which is since the beginning of the aggressive interest rate hike cycle, since the beginning of last year, we've seen risk assets, especially high-tech stocks, high beta stocks, suffering for essentially more than outside of the top 7 tech stocks in the US. But most of the stocks in the US have been suffering, and I think it is very close to the end of this suffering period for them, right? And it's likely that as the Fed ends the hiking cycle, the risk environment will become friendlier. Investors who have been underinvested, asset managers who have been underinvested, will look to put their money to work as we head into the new year as well. So, but we also need to note that risk of inflation, risk of recession remains high and remains high and likely to rise as we see more uncertainty as geopolitically, as well as as the economy starts to slow, then people will start to think about recession as well. But also another problem that we have is the debt problems continues to be an issue for the US government as well as US consumer. Debt continues to rise, and interest payments as a percentage of income continues to rise because of high interest rates, right? And these are the worries on the mind of many top money managers as well as financial figures. For example, we saw Bill Ackman, who is a very famous hedge fund manager who made a bet against US bonds recently. He was very vocal and public about it. He was betting that the 30-year bond yields will go to 5%, and it happened in a matter of few months, and he made quite a bit of money from it. He covered his bet recently. He took profits, and he says there's too much risk in the world to bet against US bonds. And the CEO of JP Morgan Chase, Jamie Dimon, also warned that this is the most dangerous time for the world in decades. And this caution is echoed by quite a number of famous fund managers as well. For example, Ray Dalio also said this is one of the most uncertain times that he's come across. And as we said at the beginning of the show, uncertainty is not a great thing, but it's a good environment to hunt for good assets.
So here's the thing, right? You talk about long-term investor and echoing what the initial quote was. The long-term investor, Warren Buffett, Berkshire Hathaway, his flagship vehicle, is now sitting on, as of November, 157 billion in cash, waiting to deploy for opportunities. To put that into its context of how much money that is, the foreign reserves of Malaysia in total are only about 110. Bank Negara, the Central Bank of Malaysia, I think has reserves of around 110 billion. So that's a lot of money for one company, and he's sitting on the sidelines on cash.
Yes, so you can imagine how much he has to deploy if the market environment becomes friendlier to risk. But also part of the reason why he's keeping cash is also US bond yields are very high, right? It's like they are earning 5% just by taking no risk, and that is a good place to be in when you have a lot of cash and the world is uncertain. So I think quite as you can see, if the most famous long-term investor is keeping his money in cash, it's likely that many funds are also keeping their money in cash, and they're all waiting for a risk-friendly environment. And eventually, if we should see that happening, if we should see inflation head towards the 2% target more aggressively over time, a lot of this money will be need to put to work, and that is when we'll start to see the market start to show strength to the upside as well.
And on that note, then, that's a lesson for me today. It's really around the fact that if all these investors who essentially have made monies decade after decade are saying go on to cash, I think that's a safe option to follow. On that note, we're going to leave it at that. V, thank you very much for your insights, and thanks for coming on the show. That's it for this week's Inside Trading Show. Now, we've been speaking to Pang V Lung, founder and CIO of Track Record Trading Academy, and this has been BizTech's Inside Trading Show. This show will be on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.